Okay, let's move on to this wonderful occurrence that happened the day before yesterday, where Caroline Flint, who is an English MP, accidentally dropped some papers as she was walking into the Prime Minister's residence, and a rather alert photographer managed to get a snap of those papers. And these were her papers for the cabinet meeting of the 13th of May, in which she was to brief the Prime Minister on the state of the housing market. And one of the quotes that all the newspapers jumped on, which was that and I quote, "Present trends clearly show sizable falls in prices later this year, at best down 5 to 10% year on year." Now, a lot of the media's jumped onto this, and they've all started talking about the house prices. And they're kind of jumping onto this saying, this is the truth, this is what ministers really think. Now, if this is what ministers really think, what was surprising about these papers was the amount of BS.
Yeah. Yeah, I noticed that too. And actually, as I'm speaking to you, I'm looking at an image of this page. And right in the middle of it, it says, underlying demand for housing remains high, and the fundamentals of the economy are sound. And it says the market's being affected by the global credit crunch, which is making it difficult for many who would like to buy. It's crap. I'm sorry, it's just not true.
The fundamentals of the economy are sound, and they're kind of repeating it like it's some kind of mantra that if you repeat it often enough, it'll come true. And I can understand why they say it publicly, but I can't believe they're saying it privately as well.
Well, yeah, because at the top, there is this bit of honesty about the at best down 5 to 10% a year. So you see a sort of honest statement like that, and then right below it, just a few lines below it, you see this sort of spin and fluff, and either they're lying to themselves and they know it, or they really don't get it. And I think I'm fearing it's a bit of both.
Here's the best bit. We can't know how bad it will get. Okay, that's a very negative sentence. But we need to plan now to put in place effective measures against the risk that it does not get worse. Well, the first issue there is it such a bad thing if it gets worse? But then it says, and to prepare for the upturn.
Yeah.
How far away is this upturn? We are continuing to monitor the situation and take appropriate action. Given that it's your appropriate action that has got us into this mess, I dread to think what the appropriate action that's going to get us out of this mess is.
Exactly. Well, the real problem is that thanks to hype and very aggressive lending, and various policies that the Labour government's been fomenting, house prices got enormously overvalued. And what's happening now is they're being allowed to come back down to earth. But are they going to be allowed to come back to earth? Eventually they will do, but the Labour government may come up with various policies to try and prop them up at artificially high levels. If you remove the hype, you change the sentiment, that's happened already, and you remove the aggressive lending, house prices fall. And they need to fall all the way back to where they're affordable again by first-time buyers. And that's not 5 to 10% off the highs. That's more like 20 to 30 to 40% off the highs. And, we're not, we're a long way from that. And there's nowhere is there any sort of reasonable, rational understanding that that's the reality of the situation.
Mike, I bought a place in 1994, as you know, and I was very lucky. I got in at the bottom of the market. And then I bought another place in about 1996, 97. And I remember moaning to estate agents then that housing was overpriced and that it had no relationship to, what a first-time buyer could afford. I don't think we're going back to anything like those levels, but nevertheless, to go back to first-time buyer affordability, it's a long, long fall. If you measure it by sound currency, it is anyway.
Well, it is, and I think I was listening. Actually, I re-listened to this podcast we did a year ago, and I recommend people do it. The one, Pear-Shaped or To the Moon, a property, moonbound or pear-shaped, I think was the actual title. And it was really interesting to listen to different points of view and how much they've changed in the last year. They've really changed dramatically. But a year ago, in July, John Wrigglesworth was talking about lenders going from 6 times earnings to 7 times earnings. And he was predicating his bullish forecast at that time. He's another year of the bullish market he was talking about, based on the fact that people were going to go to 7 times earnings. Now, normally, through quite a few years of history, 3 or 3.5 times was the maximum, and he was talking about going to twice that. So, it's really crazy, and that's why prices got so high, because the money was there through this aggressive lending that fueled these high prices. But really, I mean, now if you look at it rationally, people had to believe this big lie in order to pay that much for prices, for properties. And, the lie's not being believed anymore. Prices are coming down.
I must say, I really liked Wrigglesworth. I didn't agree with him, but I did like him. But one thing he said is, he did say, it all depends on interest rates, and if interest rates go up, then look out below. But what has happened, and I think what he meant was, it all depends on lending. And he kind of thought that if interest rates stay low, then lending will stay cheap. And he said, if lending, the cost of lending goes up, then look out below. But what has happened is the cost of lending hasn't gone up. It's just that no one's lending. Yeah, that's what nobody foresaw. And, I mean, we all foresaw declines, but we didn't foresee this drought of lending. And
well, I think if you listen to that bit again, I think you will find that actually I said interest rates don't have to go up to kill the market. It could simply be that there's a contamination, that the fears of lending from the U.S. spread to the U.K., and that's exactly what's happened. And, it's credit crunch driven, i.e. the lack of lending. But, what's funny about this is, it isn't that people have really stopped lending. It's they're really just returning to where they were, 5 or 10 years ago. They haven't stopped.
I live down in Wandsworth in southwest London, which is a reasonably well-to-do, if you like, middle-class area, and we have a lot of nice family houses here. And a year ago, everything was flying off the shelves, and now there are for-sale signs everywhere. And what's happening after a few weeks, there's a for-sale sign appearing next to the for-sale sign from a different agent. So what's happening is the guy's going multiple agent. And there was a very nice house that actually it wasn't a very nice house. It was a big house that got bought, and they've spent a lot of money doing it up. And now they've just finished doing it up, and a for sale sign has appeared. And it would surprise me if they got their buy cost plus the cost of doing it up back.
Well, that's what happens in a bear market.